So today I'm here with Christopher Carroll from Carroll CPA, and we're just discussing the benefits of stock transfers. Hi, Chris.
Hello, James.
Thank you very much for joining with me today and spending some time to answer some of my questions.
Happy to.
So as part of the Closer to Home campaign, I've been getting a lot of different requests from donors about how to make stock transfer donations. I try my best to answer the questions, but I thought it'd be great to have someone who has more experience and more knowledge on the topic to help give us some of the facts.
Sure, well, I'll try.
Okay, great. So I think the easiest way to do it is just to sort of present a scenario. Let's say Mrs. Smith, she bought a stock, say 10 years ago, that for $10,000. And now today it is worth $50,000. And she's trying to decide with me what is the best way to use that in a way that benefits our foundation and her from a tax perspective. Is this a good idea to make a stock donation in general?
Sure, it's a it's an issue that comes up at my office fairly frequently as well, and it does so because the provisions around this have changed for the better in the last number of years to make it more advantageous to do just that. In general terms, if one is simply just donating capital property, any property to a charity, you're deemed to sell that property at fair market value and trigger a capital gain for yourself before that happens. However, there's an exception to that general rule when it involves the donation to a qualified donee, the hospital being that, a registered charity, and the donation of what they term eligible property. So eligible property in this case, to your example, the most common one are publicly traded shares and bonds. So if one has that and is considering making a donation to a charity and has publicly traded securities that have an accrued but unrealized gain, it's an ideal way to both benefit the charity, which is the person's ultimate goal, of course, and as well take advantage of the rules that are there in place in the tax system. So for your example, if the lady simply sold her shares and realized the gain, the proceeds of $50,000, and then just donated those shares, she would, of course, pay tax on the capital gain, and then get a corresponding tax credit for the donation credit. But the provisions of the special election one can make when you're donating publicly traded shares is that, in fact, if you make a direct donation of those shares to the charity, that is, not cash them out, but rather actually transfer those shares to the charity, you can get a double benefit, which is really, you still get the benefit of the donation credit, in this case, the $50,000, which is the fair market value of the transfer, but you don't end up paying tax on the capital gain that you otherwise would have on the sale of those shares. So the benefit is significant in certain cases, especially depending upon how much the accrued gain is on the shares in question.
Okay, so it sounds to me like the order of events is very important. The interest is this woman wants to donate. She wants to support a charity. But if she were to just cash the stock on her own and then donate that money, it's a very different tax outcome than if she had donated the shares. Kind of a minor difference in the order of things, but a big difference for her taxes.
For sure. If that individual was in a high tax bracket, let's say she was in the maximum tax bracket, which would be in Ontario, let's say she was in a marginal rate of 46%, which is like, it would be the high bracket there. To do it and not make a direct transfer of the shares, but rather just do it the old-fashioned way and sell those shares, she would end up paying tax on the capital gain in your example, or in our example here, you have a $40,000 capital gain, of which 20,000 is taxable. So she'd end up paying a little under $10,000 in tax, $9,200 in tax more under that than if she simply transferred the shares directly to the charity. So in effect, the difference, it's in that example, it's significant, and the difference is the ability to not pay or avoid paying tax on any triggered capital gains on those shares. So it can certainly add up depending on how much of a gain is in the shares themselves.
Okay, so what if in the same scenario, Mrs. Smith had a $10,000 share purchase she made 10 years ago, and today it's still worth about $10,000. Let's say exactly $10,000. Would there be much of a benefit if she went through the process of donating the stock versus just cashing it out and donating the cash?
In your example, no, James, there wouldn't be any difference, because in that case, the individual is still getting a donation receipt from the hospital for $10,000. And that would happen regardless of whether she donated the stock or cash. But her selling those would not trigger any capital gain because there is no accrued gain on those shares. So there would really be no difference in terms of how she enacted that transaction. And the reason being is there is no accrued unrealized gains in those shares in question. And that's really where it turns. One has to look at what their particular holdings are and what potential capital gain is there on a sale of those.
Okay. So the order of things is very important, and also the actual gain in the stock is important. Okay, so what about one last scenario I'll present? So Mrs. Smith again wants to donate her stock. She bought it for $10,000 a couple of years ago. Now it's actually worth $8,000.
Mm-hmm.
Would there be any benefit to her donating that stock to a charity of her choice versus and then making up the difference of $2,000 from other cash versus just donating $10,000?
That's a particular type of example, something that happens typically at year end with people with investment portfolios where they have losses in their portfolio and then corresponding gains on other stocks. So often what people will do as they approach the end of the year, where they're looking at stocks that have declined in value, which they don't believe are going to come back in value, there is often a choice that people make to trigger losses in order to apply those losses against other capital gains that they have in the given tax year. So that regardless of whether they're going to donate stock or not, that's something that people often do. And it would be done if you were looking at a stock that you knew was not going to rebound, or you didn't feel it was going to come back to your original price. So you're sitting on unrealized losses, might as well trigger those losses and take advantage of those losses against other capital gains. Now, there is an advantage to your question if someone is already going to do that and is considering making a donation to the hospital. You could donate those losing shares to lost shares to the hospital the same way we would have done on the other example. Of course, in that case, there's no capital gain that one is trying to shelter, but by the same token, the hospital would give a donation receipt for the fair market value of the shares in question. I think in your example, it was $8,000. So they would get a charitable donation receipt for that. They still are able to recognize the capital loss on that whole transaction. So it potentially could benefit them. It's a unique situation where someone is, hopefully that doesn't happen too often to people where they have these losers, but that could still benefit them. And then those losses are applied against other their gains in their portfolio. So certainly that's another one for people to look at, especially as they're approaching the end of the year, is typically when you would be looking at something like that.
Okay, well, that's very good. And I think that's a very well-rounded look at the issue of donating stocks. And it sounds to me like it is a strategic decision, and there are many different considerations, but that generally there's enough of a benefit in it that it's worth investigating.
Yeah, for sure, James. I think, like anything, and often when I talk to clients, every person's situation is different. Of course, their incomes are different, and portfolios are different. So it's not a one size fits all solution for everybody, but it's something for people to keep in mind. And for the right person in the right scenario, it definitely has its advantages, and it's something that you should consider looking at if it makes sense for you.
Okay, perfect. Thanks again, Chris, for joining us to talk about this. Very much appreciated, and I hope you have a wonderful day.
Okay, thank you, James.